Thank you for joining us in our session on site selection in an era of COVID-19. My name is Chmura. I'm the CEO and Chief Economist of Chmura Economics and Analytics, and we're happy to be joined by Didi Caldwell here today. She's the President and Founding Principal of Global Location Strategies. She's the Vice and Immediate Past Board Chair of the Site Selectors Guild. She is one of the world's most authoritative site selection and incentive negotiations experts. Since 1998, she has personally conducted location advisory services in more than 30 countries and for domestic capital investment and foreign direct investment projects totaling nearly $50 billion. In 2008, she opened her own consultancy, and we look forward to hearing from her in the second half of this webinar. Just a little background for those of you who don't know Chmura, and thank you again to everyone who was at the 11 o'clock session for coming back to this one because of our technical difficulties. We will have copies of the presentation available for everyone this afternoon, and we will also send out an audio so that you can send that to other people if you'd like. But and finally, one other administrative thing. Feel free to ask us questions. I think you can put that in the chat box on the lower right-hand side of your screen, and we'll either stop in the middle and answer some of those, or we'll, depending on timing, take all of those at the end. So Chmura is a nationally known economic consultant group, and we also provide software solutions. Many of you probably know us from our Jobs EQ software that you use. We were founded in 1998 with offices in Cleveland and Richmond. We're about 45 economists, data scientists, statisticians, and business professionals, and we're driven by your success and satisfaction. So we have a long roadmap in terms of items that we're adding to Jobs EQ, and thank you for those of you who have provided some of the ideas. And also on a consulting side, we often go beyond what the statement of work calls for to make sure that you're satisfied. We focus on quality, innovation, and customer service. Bottom line, I would say it's excellence that drives us to serve you on a daily basis. Right before Didi starts her presentation, she'll give you a little bit more background on GLS. So my presentation, I'll be going over the economic impact of the COVID-19 crisis in the U.S., and we break it down into two stages: the supply shock, which is where non-essential businesses were asked to close and citizens to stay at home when possible. Restaurants were closed, clothing stores, furniture stores, many of them closed. So there was no supply. And so that's why we're calling it the supply shock in stage one. Then stage two is the demand shock. This is the part that we're just starting to go into now. States are lifting restrictions. Not all industries are fully operational, and people are remaining cautious. We still have the social distancing. Those at higher risk especially are staying at home. So from this phase, the demand is not there as much as it was pre-COVID. The thing that's really going to change this is a vaccine, and we'll talk a little more about what we're hearing about when the vaccine will come. And then we'll talk about regional issues that will depend mainly on the spread of COVID-19, and the type of industries in your region will both impact how many people lose their jobs and how quickly employment comes back. And then after that, Didi will take over and talk about site selection. So the national economy, the one good thing about this is we were going into it with a strong economy. GDP was growing. Employment monthly gains were up above 200,000 for many of the months previous to the COVID crisis. Here you see the last recessions. So bottom line, there were no imbalances suggesting that a recession would be happening in 2020. In fact, I don't know of one economist that says that was looking for a recession this year. There was nothing fundamentally wrong with the economy. So the way to think about this is not like a typical recession, but one where, say, we had a snowstorm for maybe 3 months and things were shut down for that period. So in terms of the two stages, looking first at stage one, the supply shock, the problem with this disease is that people are infectious before the symptoms show up, and there's exponential spread of it. So for that reason, we were asked to stay at home if we're in a non-essential business. If we can, we were asked to work from home. In this presentation, we're assuming the best case scenario, which is what seems to be playing out now, that it lasts through the end of May, and then the economy starts to open up. So how has this looked in terms of the economy? Employment is the broadest indicator of economic activity that comes out on a monthly basis, and it's an important one because it comes out the week after the month ends. And here you can see a decline of 700,000 in March, which was surprising to many economists because the survey is taken during the week of the 12th. And at that time, the economy had just started to shut down. So 700,000 was quite a surprise. But look at this number compared to the last recession, not quite as bad. But now flash forward to April and look at this decline of 20,500,000 people lost their jobs. You can barely see that 700 loss here, and it dwarfs what we saw over the previous recession. The unemployment rate was up to 14.7%. Another way to look at this is the total jobs in the US. You can see the growth over the recovery, and then 2 months worth of decline basically wiped out all the job gain that we saw over the recovery. Now, employment is considered a coincident, maybe even a lagging indicator, but we have job postings that we pull from Jobs EQ. So we spider a lot of sites, we deduplicate the information, and then here we're looking at job postings falling off in the US about 55%, and now starting to see a little bit of an increase, which is really encouraging because that's showing us that this economy is now starting to recover. So in the recovery phase, stage 2, again, we're calling this a demand shock because people are not out there spending as much as they would have otherwise. So bottom line, for this economy to open up successfully, people need to feel safe. If we have testing and tracing of the virus, that certainly will help. If we have more frequent or better effective treatments that can reduce the fears and the need to social distance, that will help again too. But the real game changer will be the vaccine. And here, a vaccine often takes years, if not decades, to develop. But most experts are telling us right now, the epidemiologists and the doctors, that we could see a vaccine by mid-2021. And so basically, again, what the epidemiologists and doctors have been saying is that assume it will be widely available in the US by the first quarter of 2022. Now, if we see something a lot sooner, then our forecast will be a lot more optimistic than we're going to show you here. But again, when the vaccine comes is a big driver of the forecasts that you'll be seeing here. So now in the stage 2, the recovery starts in June of this year. And I'm talking about GDP now, but we have massive declines in April and May GDP that will swamp that modest growth in June. Some states lifting restrictions sooner than others, but still we have social distancing, and the recovery will vary greatly again by industry and region, and we'll look at a vulnerability index that we have a little bit later here. So what does GDP look like in that scenario? We already had first quarter come out a couple of weeks ago. It was down 4.8% annualized. We're looking for an annualized decrease of 18.4 in the second quarter, 1% in the third quarter, and then a rebound to 4.4% in the fourth quarter. Unemployment rate peaks at 17.6% in the third quarter of 2020. Here's what it looks like graphically. So we've already seen this decline in GDP for the first quarter. We're looking for 19%, 18.4% annualized decline in the second quarter. That's a little misleading because we talk of it in terms of annualized, which means that it happens for 4 quarters in a row. So if we don't annualize it, this decline is actually for that quarter down about 5%. Notice we have a small decline in the third quarter, then a rebound taking place in terms of real GDP. Now, some economists, we've got our forecasts all over the place. Some economists have this quarter down 40%, an annualized 40% in the second quarter, but they have an increase starting in the third quarter. And all of our assumptions vary based on how long we expect the virus to last? How many regions will it impact and how many industries? But the one thing that we all agree on is that it will be sharp and short, but not sustained. So I've had reporters asking me the question, well, is this going to be a Great Depression? And my answer is no, it's not a depression. If you look here on the right-hand side, in terms of real GDP, it fell 27% from 1929 to 1933. So it was over a long period of time as opposed to just a quarter or two. And the unemployment rate rose to 25%, but importantly, it was above 10% for over a decade. So clearly, what we're going through here is not a depression, but is a recession that is being caused by everyone having to stay at home, to social distance, to keep the death rates low from this virus. Now, when we look at the employment recovery, it's going to vary by industries. And this is very different than the GDP. GDP is going to bounce back in the third, fourth quarter, first quarter next year, and the economy is going to be doing very well from that perspective. But in terms of employment, restaurants, retail, entertainment, lodging, slow recovery. And by the end of the year, we only expect to see half of the people who had been laid off back working in those industries. But if you take, for example, utilities, professional services, and company headquarters, employment, we expect to be almost fully back to pre-COVID by the fourth quarter. So only 10% that are still laid off there. One of the issues in this downturn is that we're seeing bankruptcies occurring, and we're going to continue to see bankruptcies the longer that we stay closed down. We don't have very good data on this right now. These data come out with a pretty good lag on it. So we expect, given our assumptions about the vaccine, that we'll reach the pre-COVID employment levels in the third quarter of 2022. So from an employment perspective, this is going to stretch out for some time, but from GDP perspective, we're going to see a quick bounce back. So one other thing, the payroll protection program is playing an important role in the recovery, and we took that into account when we looked at the numbers in terms of when is the rebound going to start to occur, and then how long is it going to take us to get to the pre-COVID levels of employment. So here you see the recovery without PPP and then the recovery with PPP. The Small Business Administration has been good about providing data on which industries have received those loans, and so we use that to help us determine this, as well as the flow of other industries in terms of when the jobs come back. Now, this is an index, and this is showing you the employment drop off and then increase for these sectors, the two-digit sectors. And when we did this analysis, we did it at a four-digit NAICS code level. For example, retail trade, this is a two-digit NAICS code level, but four-digit would be grocery stores versus furniture stores. And of course, those would react differently in terms of employees coming back. So since we indexed it to 100, that's at the peak employment before COVID-19 virus occurred. The way to read this is that this particular industry, which is arts and entertainment, will see a loss of 80% of its jobs until we start to see it coming back and then climbing to where it finally gets to the same level it was when it started. Accommodation and food services, also one that sees some significant declines. And now I'm going to peel away some of these larger declining industries so that you can see some of the others. Other services, this is 75, so that means they're seeing a 25% loss of jobs. Other services are things such as barbershops, salons, photographers, and then you could see the increase coming on the other side. Green here is retail trade. So the job loss there is fairly significant. On this next slide now, the red is wholesale trade and the yellow is information, so computer related businesses, and then the green is healthcare. And notice that once we hit the pre-COVID levels, it continues to grow. So showing some growth overall in employment for that industry after hitting the pre-COVID levels. And then finally on this one, we're showing manufacturing in red. So notice here only a 5% loss. And again, remember, this is the average for the manufacturing industry. There are some industries such as vehicle manufacturer or tires that have closed a lot more than just 5%. But when we look at all of the industries in aggregate, under manufacturing comes out to about 5%. And then notice this one is interesting. It increases, but right when we get to the COVID, where it almost gets to the COVID levels, it starts to decrease. That's taking into account our long-term forecast, which assumes that manufacturers continue to become more productive, which is good. They can pay their employees more, but that means they're doing more with less people. Now, this may be wrong if we see a lot more of the supply chain coming back to the US, and maybe Didi will speak about that. But certainly pharmaceutical and protective equipment is what the federal government has been talking about, encouraging companies to come back to the US. But we may even see other industries coming back as they struggle through supply chain issues with this pandemic being global. Yellow is education, and then green is public administration or government. Now, switching gears a little bit, here we're going back to looking at job ads. And here you can see the total and how we saw the decline, and now we're seeing a little bit of an upturn, which is good. Another encouraging sign is the food group, which is orange. Notice it hit its bottom in March 29. Again, these are job ads from Jobs EQ, and we're starting to see an increase on that, encouraging to see that, as well as personal care, especially since April 19th, job ads have really increased there. So we have great variation by region, and I'm sure that some of you have seen this site, which is from Johns Hopkins, and you can drill down on this map and go to particular counties. So I find that to be very useful. Here's the site where you can go to. And then this is another site many of you have probably seen where you can change this and go to particular states and see what the track line is for the projections of deaths, as well as the confidence interval around that. So when we first started with COVID-19, trying to figure out what is going to be the employment loss. So we went to, again, the 4-digit level in the US, and we gathered data about what experts were saying on how much they expected to see employment losses. We looked at our job postings, we looked at initial claims, other data, and then we came up with the percentage loss in each of the industries in the US, and then we applied it to every county here. And in this case, again, we're looking at the US as 100. So if your county is, say, for example, 90, then that means that your employment loss is expected to be less than that of the nation. If your county is at 110, 120, then we're looking for the region to be harder hit by the COVID-19 virus. Here's where you can go and download the data if you'd like. And here is a list rank ordering the industries most impacted. No surprise, accommodation and food services, art and entertainment. With those less impacted, active military or company headquarters, professional businesses, because many of those individuals can work from home. So in conclusion, the virus will end. In terms of the GDP, we're looking for sharp and short, not sustained. But when we look on the side of employment, we've got that first stage, supply shock, and then the second stage, demand shock, assuming that the vaccine is not available until mid-2021, and then widely available in the first quarter of 2022. Under those assumptions, employment does not reach pre-COVID levels until the third quarter of 2022. So with that, I am going to stop sharing my screen, and I'm going to turn this over to Didi.
Hello, everyone. This is Didi Caldwell with Global Location Strategies. Thank you so much for joining us today. I look forward to providing you a little bit of an update of what we're seeing in with regards to site selection and what's happening with companies. I thought it would be good just to talk a little bit about global location strategies to begin with. We're a purpose-driven organization, and our mission and our purpose is to really unite companies and communities together for long-term mutual prosperity. And we're not just looking at economic prosperity, we're also considering social responsibility, environmental stewardship. So more and more of our companies are in tune with that, and it's something that we are very passionate about as well. Just a quick review of 2019. So we had 3 announced projects. You can see the distribution there. But one of the things that's really interesting is that we looked in over 67 countries. Now, obviously, we weren't on the ground in 67 countries, but at least from a location benchmark, we were considering that many countries. And we looked at 194 sites worldwide, and that covered 26 states. So a pretty broad geographic distribution. And to the extent that we are a microcosm of the larger economy, I think that bodes well for many parts of the country. So I thought it would be interesting to look at what we were seeing way back in January 2020, if you can remember that. We were seeing a continued high level of activity for site selection projects of all types: production, warehouse and distribution, office. It seemed to be a really broad sector activity level. Like Chris said, it was a very strong economy, and I was sort of wondering when the shoe was going to fall. And if you were like me, I had some thoughts at some point, which I feel really guilty about now, that I was thinking, a little mild recession might, shake the trees a little bit and, get companies more focused and separate the wheat from the chaff. But I really, really did not anticipate nor wish for anything like this. But we were already starting to see some shifting supply chains that were driven by many different things, but companies were taking another look at where they were producing and where they were sourcing their inputs and starting to make some shifts. That all meant that there was an accelerated interest in North American investing. I think I spent the first half of my career moving companies out of the US, and now I'm spending the second half of my career moving them back in. But they are different kinds of projects. So what's driving this? So the first thing is the shifting energy landscape. So if you remember when there used to be a lot of investment back in the early to mid 2000s that was focused on importing LNG. And then this thing called fracking came along, and suddenly those no longer became relevant, and many of them have been converted into export facilities. So the fracking revolution really changed the energy landscape for the world and made the US much more competitive from a price standpoint, and thereby it has shifted a lot of that capital-intensive, energy-intensive investment back to the US. So whether you're using energy as a source, whether you're using electricity or gas as a source of energy or heat, or if that's actually one of your inputs, then you had a better cost position here in the US. The second one was international geopolitical risk. Now, I had this slide prepared and done in some presentations that I did before COVID-19, and this is Hong Kong. If I were showing this slide now, I would probably show something that had to do with the virus, because no one really anticipated. We look at natural disasters, we look at social unrest. I've done a lot of business continuity assessments for companies, and pandemic has just, I have to admit, it has never been on the list. It's sort of like, one of those things that could happen, but was not really something that we knew how to measure. But this international geopolitical risk that we were already seeing associated with trade and tariffs, with regional conflicts, social unrest, that was causing companies to say, have I adequately priced the risk that is associated with these multi-tiered, complex global supply chains? And if I haven't adequately priced it, then maybe I need to take a second look at that, and that may cause me to reallocate my production and my sourcing from where it is currently. And finally, U.S. is a growing and stable market. So if you look at our demographics, we have a pretty healthy demographic, which still has a strong consumer class. Unlike much of the developed world and some of the undeveloped world, we are not facing mass retirements. So if you're a company and you are counting on consumers to buy your goods, then the U.S. is a great place to be. And then all of a sudden, everything shut down. This was obviously unanticipated. I mean, maybe we could have anticipated it back in January or February, but I will admit that I did not fully grasp what could potentially be happening here. And since then, we've just seen it's kind of been a mixed bag. So the way that companies are reacting to this really just depends on their cash position, where they are in the site selection process, how heavily they are impacted by the coronavirus. If there's anything that's associated with with tourism or consumer items, things like that, then it's been heavily impacted. If you're more in, if you're in petrochemicals or oil and gas, you've been impacted because of what's been happening in the oil market. But we haven't had a project that has been completely canceled. We had one project that was really at the 1 foot line, and they went on an indefinite hold. And they are a producer of a product that is used in the building industry. And I think there's a lot of uncertainty about what happens from here. So that has been put on hold. We also had another very, very early project that was in the metals industry that was put on hold, but they really just hadn't even gotten started yet. The rest of the projects that we were working on that were in progress have continued, and we've actually seen a couple of new projects since then that are moving on despite what's happening. A lot of the projects that I work are big, heavy industrial projects. It takes years to develop these projects and get them online. So based on what economists are seeing, such as what Chris was showing, is that this is going to be a very sharp but temporary slowdown. And so they're anticipating that by the time they get up and running, the economy will be back humming again. So if I look into my crystal ball, I really should have just called Chris up, and she's better than my crystal ball, because my crystal ball is not just broken, it actually lies to me. So, but if I were to try to synthesize all of the things that I have been hearing, I probably couldn't do as good a job as just looking at what the rest of the market is telling us. So the Site Selectors Guild did a consultant survey. I believe this was at the end of March, early April. And 81% of the consultants that were surveyed said that the virus will have a major impact on global supply chains. So that's a pretty overwhelming number. And they're seeing a mixed bag like I am. So kind of not quite 50-50, but about 50-50 of projects that have been paused and those that are going forward. About half of them predict that they restart the project in Q4 2020 and about half in 2021. If you think about what Chris was talking about, how long it's going to take us to recover, just because they restart their project in the fourth quarter or even in the first quarter of 2021 doesn't mean they're going to make a decision in that time frame. So I do think that timeframes will be pushed out for many reasons. One is uncertainty. One may be, availability of cash. A lot of my companies are venture capital backed, and so that's just more constrained to get financing right now. And the third reason is because we're finding it difficult just to get out in the field. Companies, our clients, oftentimes can't travel. Sometimes we're seeing a bit of reluctance on the part of the economic development organization, either because they're just resource constrained or because they're still nervous about the virus. And that's very regional. It depends on where you are. There's also another survey that came out, and this one has been very interesting because they did it in February, March, and April. And this is Thomas for Industry, and they have surveyed manufacturers or people involved in the manufacturing industry. The vast majority of them are either OEMs or custom manufacturers. there were the response numbers have been going down a little bit, but still 878 qualified responses during this period of April 16th through the 19th. And this has been looking at how likely are you to bring production or sourcing back to North America after this outbreak. And as of this April, 64% of them said that they were likely, very likely, or extremely likely to do so. And that is pretty substantial. And it also represents a 10% increase since March. So it looks like that manufacturers are also taking this into heavy consideration at an even growing rate. If you look at the ones that said that they were most interested by industry, you can see there that manufacturing, automotive, agricultural, these are the ones that are look most likely to reshore either production or sourcing back to the U.S. And then finally, 91% of them believe that a recovery was possible. So they remain optimistic about the future prospects once we get through this sustained or short recession. And a lot of that is obviously going to depend on how long it takes to get the vaccine, or how long it takes for us to get herd immunity, or wherever it is that we come out on the other side. So some of the things that we're watching right now, the first one is the price of oil. I mentioned this earlier, and this is the price of oil going all the way back to 1870 in real US dollar terms. So this is, adjusted for today's pricing or value of the dollar. And you can see that never before in history has it even come close to getting to zero. And we saw a really short period where West Texas Intermediate dipped below zero. And depending on who you listen to, we may not be done with that. The storage capacity in the world is filling up, and it's very, very difficult to turn off the wells in some of these areas. So we could be looking at a place where not just in one area during one period of time, but more of a global phenomenon where producers are actually paying people to take the oil off of them. That has all kinds of impacts, not the least of which is here in the U.S. to the employment and the employers in that industry. Obviously, this is a very difficult time for them. But if you think about the countries that are huge oil exporters, so think Russia, think Nigeria, think Saudi Arabia, they are going to be heavily impacted by this, and this could have real social, economic, and political implications. The other thing is, what Chris was talking about is these job losses at unprecedented numbers. This is from The Economist that was talking about how unemployment may still be close to the peak reached in the aftermath of the financial crisis some 20 months from now. So they are also predicting that this will be a long, slow recovery from an employment standpoint. I talked about the multi-tiered global supply chains before, but this is just a way to visualize it. So when you go back to the companies or the types of manufacturers that are looking to relocate their production or sourcing back to North America, this is just an example of what the 787, some of the components of the 787, where they come from. And you can see it truly is global. We've had intermittent regional supply shocks. If you think back to Fukushima and the impact that it had on the automotive industry, the floods in Thailand that same year that had impacts on the semiconductor and electronics industry. You can even think of Katrina here in the US. But this is probably the first time that we have had a global sustained supply shock since World War II. Some might argue that the oil embargoes of the 1970s were somewhat similar, but I think this has been much more painful, and you can see that in some of the statistics that Chris was showing earlier. So how do you mitigate that risk? I mean, you can build up safety stock, you can build or source a redundant supply, or you can collapse the supply chain geography. I was on a panel last summer with someone from Toyota, and they said that they had made it a priority to make where they sell. And that was in 2019. And so now I'm just wondering, are they also thinking about, are we also going to buy where we make? I don't know if Toyota's having those conversations, but I know that there's lots of manufacturers in the boardrooms are talking about those very things right now. And finally, the confidence in the U.S. dollar. So we have provided a stimulus package, which I think right now it goes up every day, but somewhere in the neighborhood of $3 trillion, which under ordinary circumstances would make your dollar worth less. But the dollar is still seen as safe harbor in around the globe. So the U.S. Treasury has had absolutely no problem selling 10-year notes at record low yields. I think last week, or maybe it was just a couple of days ago, a few days ago, they sold $32 billion of 10-year notes at the lowest yield ever of 0.7%. So confidence in the U.S. dollar is really, really important. And that makes our flexibility, our government's flexibility to issue, to provide stimulus to the economy to keep it going, unlike anywhere else in the world. So what does all this mean? Keep calm and embrace the chaos. I think that there are several things that you can be doing now as economic developers to make yourself in a better position and able to emerge from this actually stronger than when you went into it, especially from a relative position. Because I think there are going to be some geographies across the U.S. that are going to retrench and try to protect. And then there are others that are going to be aggressive and take a little bit more risk. And I think those are the ones that are really going to benefit from what I predict to be a major relocation of manufacturing capacity back to the U.S. So what are the keys to thriving in this new reality? So I've walked through a few of these. Become more investment ready, know where you compete, take care of your existing industry, because two birds right now in the coronavirus bush are just useless. At some point, they might be worth something, but until we can get out in the field and until companies have confidence, they're just not going to be making those decisions. And then shoring up your budget. I think you need to be looking at 2021, 2022, and how you're going to continue to support your economic development efforts. So the first one, some of you may have heard me talk about my Holy Grail, and I am still in search of it. But the Holy Grail site is typically what you can put a tissue plant on, because it's both capital and labor intensive. 200 acres, rail served, 25 to 100 megawatts of power, 2 to 8 million gallons of water a day, and about 2/3 of that in wastewater discharge, about 1,400 MCF an hour of gas, air quality attainment, capable of employing 500 to 1,000 people, and access to highways and interstates, and a large population. So those kinds of sites don't grow on trees, but I'm still out there trying to find them. But the point of this is that you have to constantly be building your inventory. So the first phase is to identify a piece of property. You evaluate it to make sure that it's going to fit your needs and fix a hole in your total site and building inventory. Then you do due diligence and acquisition, and then you start marketing it. Well, when you start marketing it, that is the time to start looking for the replacement of that site. Because if you wait until someone announces on that site and uses up that product, then you're going to be out of the game for a couple of years. So you want to constantly keep that cycle moving. One of the things that we have been doing recently to help companies become more, communities, is this virtual site visit training. So we started doing virtual site visits back in 2012. And it was really a way for us to more cost efficiently and more quickly evaluate locations for our clients. Back then, the technology was pretty rudimentary, but we persevered, and obviously it's gotten much and much better. And at this point, we are in really good position because we've become pros at this. So we've always done this for our clients, but now we've also launched a training program for communities where they can do virtual site visit training with us. Virtual site visits are, here to stay. They're not going to change. More and more people are going to use them. Even when we get back to a more normal business as usual, I think we'll still have the virtual site visits because companies are realizing that this is a way that they can look at more sites in the early stages of the process, and that the clients, the companies themselves, can be more engaged in the site selection process at an earlier stage, because it's much easier for them to join a virtual site visit in either an active or a passive role than it is for us to go out with us on the consultant site visit. So it's been a game changer, and I would encourage you to sharpen your skills when it comes to virtual site visits. The second thing is, knowing how you compete. So location benchmarking is a thing that we do often for our clients. And you can do this yourself, is just understanding where you stand on your quality aspects. So for example, the quality and availability of your labor, the financial aspects. So, what are your payroll costs? What are your other costs that are going to impact a project, like energy costs and site development, et cetera? And then also on risk. And so when we look at risk, we're really looking at risk associated with either the budget, the schedule, or the ability to operate now and into the future for that particular operation. So as we go through the site selection process, we look at 850 data points. You've seen this funnel. Everybody has a funnel, but we're trying to get down to the ones that really make the most sense. And we're really trying to understand those trade-offs, because the best location is obviously the one that has the best quality, the least cost, and the lowest risk. But oftentimes the companies making these decisions have to make a trade-off. And so our process is designed to help them understand what those trade-offs are here. So you can do this with different types of projects. And if you want to understand why you've been eliminated, just pick some of your competitors, come up with some criteria, score yourself on them, kind of on the back of the envelope, look how you compare on cost. And you can see whether you're falling in what I call heaven in the upper right-hand quadrant, hell in the lower left-hand quadrant, and then the other two are purgatory. And if you're in hell, maybe you should be looking somewhere else. If you're in purgatory, are there things that you can do that could either improve your quality or decrease your cost in order to get to heaven? And in heaven, don't take your eye off the ball. Continue to look for ways that you can be more competitive. So this will help you really target and understand where you need to be focused. Be someone to lean on. Your existing businesses are really, really critically important right now. And we subscribe to FDI markets. And if you go back and you compare, they only track cross-border investment. So they're only looking at non-US companies looking in the US companies looking overseas, or non-US companies looking in non-US locations. But they also track interstate investments. But they would not attract a company that was, say, based in Virginia that made an investment in Virginia. They would not track that. We think it's a fault that they should do that, because we don't really care where the company is headquartered. We want to know about the projects. But nonetheless, if you go back and you look at that, when you compare the percentage of projects that come to fruition that are expansions versus new greenfield properties, or just not necessarily greenfield, but new to that location, it's about a 2-to-1 margin. So that's where, taking care of your existing businesses is really important. And you also have to do this balance between the traded clusters and the local clusters. So the local clusters in the US and in many places, they make up, about 2/3 of the employment. And these are things like your restaurants and your drugstores and your elementary schools and that sort of thing. Really important. You need to take care of them, but that's more of a community development. And I know that you're not necessarily focused on that, but I just want to make sure that we don't forget them. But if you look at where the income and the innovation comes from, it's in the traded clusters. So those are the businesses that are really the engine for your economy, and you want to make sure that you're taking care of those. And then finally, you want to avoid the chopping block. I've just got some numbers here for South Carolina. They're expecting tax revenues to fall by $507 million or 15.5% by the end of FY 2020. I don't know what 2021 looks like, but they're predicting general fund revenues could go down by $643 million or about 257% below the February estimates. I think Arizona just came out. They've got a $1 billion shortfall. Then this is happening at both the local and the county and the city level. And I'm a little bit concerned about economic development budgets, both to be proactive in the site development and workforce development, to be reactive when we have projects that come to them. I want to make sure that there's experienced staff that can help us work the project and understand what their value proposition is. And then finally, what can they do in terms of incentives? I do expect to see a lot more things that'll move to performance-based incentives, which is something at Global Location Strategies we believe strongly in. But you also have to have good ready sites, which, if you do the site prep before the company gets there, that's just an investment. If you give them the money to do that work, or you do it as a result of them coming there, then that's regarded as an incentive. Regardless, you need to have good sites and buildings. So I worry about what happens to that revenue and how these economic development organizations are going to be funded. So I would encourage you to think about that as you move forward before we actually get to 2021. And then, I think this is really appropriate here from Winston Churchill. If you're going through hell, just keep going. I know we're all going a little bit stir crazy here, but we will get through it. I think what Chris showed us, although it may not be exactly what we want to hear, it was encouraging to see that we are going to get through this. And hopefully a vaccine will be here before you know it, and we'll be back to business as usual. So that is all I have today. Thank you very much.
Thank you, Didi. That was very informative, a lot of good information. And I'm sure there'll be some questions coming for you. But in the meantime, I have 3 here that I'll address. First question was, what is a coincident indicator versus a lagging indicator? So a coincident indicator would give us what's going on with the economy right now. So let's just say employment would be the coincident, giving us a sense of how much is this economy growing. GDP might be another good one, except for that it's only out quarterly. So using employment as a coincident indicator, then initial unemployment claims is a leading indicator, because first people get laid off and then they don't show up in the employment numbers. So that gives us initial claims gives us a good leading indicator of what employment's going to do. And then government employment would be a lagging indicator, because and Didi made this point well, that we're going to see some reductions in sales taxes and revenues to governments. So government typically will lay off people sometimes a quarter or 2 after a recession ends. So government employment would be a lagging indicator. Another question, why are job postings a good way to measure how the economy is doing? And the reason there is because they're a leading indicator. So if my business is going down, I'm not going to be hiring people, so I don't post any jobs. But if I see that my business is growing and I expect the demand will be sustained, then I'm going to be putting job ads out there for more people to help do some of the work that come in. So again, that's why that one would be leading. And then here's another question. Are you saying the recovery will be more of a W and less of a V or U? And that's a good question. I think it's going to be a swish, like your Nike shoes have on it. And that is, so it's gone down, or another way you could say it's a V that's not symmetrical. So we see the economy going down, and then in terms of employment, it's going to come back more slowly until it gets back to the pre-COVID levels. Third question here, when we entered the COVID-19 period decline, we had millions of jobs not filled. You have employment coming back in 2022. How do you believe those unfilled jobs could help buffer or speed up employment with workers changing or training for new careers. Unfortunately, some of those unfilled jobs back in 2022 probably will go away. It depends on what industry they're in. If restaurant, retail, some of those will have gone out of business. But certainly computer IT jobs, we haven't seen those drop off much in terms of job postings during this downturn. But clearly there's an opportunity here to train for new careers. If you think about the unemployment insurance, the federal government has, under the CARES Act, has given unemployed people $600 a week for 8 weeks, which would take them to July, on top of whatever the state gives. So in Virginia, the state gives about $350. So some unemployed people are getting $950 a week for 8 weeks, which if they're in a low skilled position and paid less, then that $950 is probably much more than they would have been making if they were working. So that's an opportunity for some of these low skilled workers to find some certifications or some programs where they can get skilled for positions that are in demand. I'm looking to see if Avery, here's questions number 2. And Didi, can you see the questions at the bottom? Would you like to address any of those? It's an email from Avery. Well, while you're looking for that, Didi, let me go ahead and answer this other one. Oil and gas. When you considered job losses, did you also include industries that were directly impacted, such as oil and gas? They haven't been impacted by the virus directly, but the drop in demand for energy. Absolutely, yes. So we did consider the drop in demand because of the reduction in the price of oil was taken into account.
And Chris, that was my question, and that was specifically about the impacts from COVID-19, that map that you show on a county by county or MSA basis.
Yes.
Mm-hmm.
So we do take into account the ripple effect that's occurred. So that we've updated that map, the vulnerability map, once now, and the reason why we updated it was because of those ripple effects and because the impacts were larger than initially thought by many experts. And then Didi, I see there's a question for you. With the change from in-person site visits to virtual, what are you looking to see or hear during these virtual tours?
So what we're really looking for there is we do about 80% of everything that we can do on the ground. We just do it virtually. So we've actually just, if you go to my LinkedIn page, we've actually just released a video that walks through what a virtual site tour is and how to ace yours. But you really need to assign a quarterback. So we would, if we were holding the virtual site tour, we would send you an agenda and we would let you know all the topics that we wanted to cover. We usually start out with a little bit of an introduction because, you know, sometimes companies are coming from other parts of the world and they don't really know where Greenville, pick your state, is. So, you know, kind of starting broad and then focusing in, it's appropriate to have a little bit of a quality of life type, either a video or a short presentation to show what your community has to offer from a recreation and arts and entertainment and just demographic standpoint. But then we really want to get into the details of the site and going through all of the things that are going to be critical for success. So that includes workforce, and includes the site itself or the building. It includes environmental issues, utilities, logistics infrastructure, and we'll talk about taxes and incentives. And depending on the complexity of the project, it's anywhere from 2 to 4 hours long, which is kind of a marathon. But we structure it so that there's like at 11 o'clock, we're going to look at utilities so that those people don't have to be on the whole day. Having drone footage is really useful. The only thing I would say is that sometimes with the connection, it's not possible to have live video feeds because you're having a video feed of a video feed. So sometimes it works best just to have a link there, but certainly drone footage, particularly that's been augmented with visuals that might show conceptual layouts or, where the property boundaries are, the utilities. Those are extremely helpful. But the key thing is to have the appropriate technical folks to cover each subject area on the call at the appropriate time. And it's really a game changer because, there might be some things, particularly with our clients that participate in these calls, there might be things that we give you a pass for. So, if the water guy gets up there and says, well, we don't want to have a big water user and, we're looking for, 1.5 million gallons of water a day. And that may just be his personal opinion, but you need to have that discussion with him beforehand. We would give you a pass more than likely if we understood where that was coming from. But sometimes the clients will just say, we don't think that they've got their act together and that's not a place we want to go. So really making sure you get your team all singing from the same hymn book and coordinated on what the message needs to be.
Thank you, Didi. There was one question about how accurate is forecasting, and forecasting the economy is difficult in good times. So as I said, when we were going through here, this forecast is dependent on the medical epidemiologists and doctors being correct in when the virus is coming. So it could be much longer, it could be much shorter, but given everything we know, given how industries are reacting, it's our best forecast right now with the models that we're using. And then adding on to that, someone said, and I feel bad for you guys, the confidence in the projection is impacting appraisals, particularly in the lodging industry. The variability in projected recovery has appraisals we've seen being out 4 to 5 years. Yeah, the lodging industry is a particularly difficult one. And I wouldn't be surprised if we're 4 to 5 years. And similarly with the airline travel, that's going to be an industry that is hard to come back. It's going to be a while before it gets back to the levels of pre-COVID. But again, a vaccine would totally be a game changer here. Didi, another question for you. Is the aircraft chart GLS production?
No, that's actually from Boeing.
Okay.
And then another one, I'm sorry, Chris. If by where we make concept happens, what kind of mile radius around their site seems to be a reasonable option? And I'm going to use the site selection consultant's favorite answer, which is it depends. But if you think about the lean manufacturing concepts that have been in vogue for several decades now, and the just-in-time and just-in-sequence type of inventory strategy is kind of what got us into this pickle in the first place. So when you're just in time and you're trying to keep your safety stock at the lowest level possible, because that is the least cost, it is also the highest exposure for risk. So I think that you could draw your providers closer, or you could just build up your safety stock. And it's really just going to depend on the dynamics and what's most economically feasible and also has a reasonable level of risk. And that's going to be very project and company specific.
Thanks, Didi. I actually had one question for you. Given what we've seen with Boeing and the aerospace industry, and then the problems that they've had with the one plane, as well as airline travel, what do you see for aerospace and the supply chain there going forward, and just demand?
Yeah, I think on the defense side, it's still going to be strong, but certainly on the on the airlines and commercial liners, I think that there's going to be a significant impact. I mean, we're talking about 4 or 5 years before we get back to the level of travel. I heard something the other day that the travel that is happening, the air travel that's happening daily in the U.S. is equivalent to what was in the 1950s. So, that employment thing looks like a swish, the employment recovery. I think this one looks like a drop off and then a very, 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 very gradual climb back up. I think we're probably looking at something pretty long. I hope that I'm wrong. And like you said, a vaccine might change that completely. my suspicion is that we're going to look back on this in probably 10 years, but certainly by 20 years, and it's going to feel like ancient history, kind of like February does right now. And because, I think it will be faster than we think. If there is a vaccine, I think it will occur faster than we think, that we'll get back to normal. I was in Hilton Head this weekend and they were partying like it was 2019. I mean, the tables were a little further apart. There were a few people with some masks on, but it was a little bit shocking and a little bit scary for me. But I think people are really dying to get back out there, and they just need to feel more comfortable.
Thank you. And you're still feeling well after being next to all those people?
Yes, actually, I am feeling well. So I hope that continues. Touch wood. We were being careful, but they were not being so careful, which makes us at risk as well.
Right. Okay, I'm looking here. I don't see any more questions. Perhaps we'll give it one more minute to see if anyone has any questions.
I thought I saw one. Oh, Oppie said, I'd like to expand more on the reshoring and transportation and logistics issues we are now facing. So one of the things is this has been pretty devastating. I mean, the logistics industry was already in a recession before shipments from China, intermodal shipments, rail shipments were way down. And so they've just been hurt even more by this. I do think that we're, on the flip side, fuel is pretty much free almost. So there is that to look forward to. But I do think that I don't know. I'm not an economist, so I would leave that to Chris. But I wouldn't be surprised if we saw a contraction in that industry as these supply chains start to really regionalize a little bit more, or at least that the logistics operations realign. I think that north-south, the USMCA, I think there's still going to be a lot of trading that happens there. We're not going to make wiring harnesses here in the US. The labor content is just too high. So that's going to go to Mexico or even, other places in Central or South America. So I do expect there to be trade. I just think it's going to be more hemispheric than it is global.
Okay, I do see some more questions have come in. One of them, any opportunities for rural areas with regard for health concerns related to dense population areas? That's interesting. I had a call from a reporter in New York City who was interested in our vulnerability index because he felt that people in New York City, for example, would be interested in seeing where around the country is the risk less, because as he was talking to some of his larger clients, they were taking this approach almost like 9/11. I no longer want to have everyone at one spot. I want to disperse them around the country, which would actually be great work for Didi and GLS to help them through that. I've heard the majority of entry-level jobs aren't posted. Is this true? On the construction side, less of them are posted because it's more word of mouth. But retail, entry-level jobs, yes, those are a lot of them are posted on the job postings. And then I have a question here for me, but I think it would be better for Didi to answer. What opportunities will there be for EDOs post-COVID?
I guess that depends on if you mean the organization themselves or the people that work there. Hopefully that you will all be still be gainfully employed in economic development. I think we're going to have to reinvent ourselves a little bit, because at least for the foreseeable future, trade missions and traveling to trade shows and going to visit site selection consultants in their home communities and hosting FAM tours is not, going to be something that we can do, at least in the near term. So I think getting really creative about how you do your targeting and your marketing, so that you're top of mind. We've obviously been doing these virtual site tours, but we also, for regional or state organizations, we'll have visits, economic development visits, just like we do when people come to Greenville in our office. We obviously have to schedule them, well in advance so that we don't get overloaded. But that's a really good opportunity, and I think it's a time to focus on the initiatives that you've been putting off for some time and haven't had the time to do. Some of you still may be really busy working projects, and that's great. But to the extent that, I know at GLS, I've used the time that I'm not traveling to start focusing on some of my technology issues. And that would be something, invest in your GIS, your geospatial technology, because it's really a game changer. Invest in your buildings, understand how you can improve your workforce, and then take care of your existing clients.
I think I see just one more here, Didi. What about virtual industrial buildings if buildings are limited?
Yeah, I get mixed reactions on that when I talk to site selection consultants. For my projects, I would say a virtual building might actually be preferable to a real virtual building because so often my clients need something that is purpose built, and you can't necessarily hang a 5-ton crane from a spec building structure, so I think that virtual buildings, particularly ones that have kind of been pre-permitted and are designed and are ready to go, and you can show that they can be up within a 90-day period or something like that, is the next best thing to having an actual spec building.
Thank you, Didi. And thank you, everyone, for attending this webinar with us. This has been very interesting and useful information, Didi. So we're glad that you were able to join us. And please, everyone, stay safe, but get out there and start spending some money.
Yes.
All right. Thank
Excellent.
you.
Thank you.
Mhm.